Okay, so if you've been around the world of crypto and decentralized finance for any amount of time, you have probably heard the phrase impermanent loss. And it sounds like this big spooky thing looming in the background that is set to steal all of your profits if you even think about participating in a liquidity pool, right? It's not that. So today I'm just going to sort of demystify impermanent loss, explain what it is and what it isn't, when it might matter, and when it is actually a negligible variable, all things considered. Okay, so let me share the screen. We're going to dig right in. And my goal here is to not only help you understand impermanent loss, but bring you to a place where it doesn't have to be the spooky boogeyman in the background. Okay, so let's dig right in. First of all, what is it? Well, we're talking about price ratios. Okay, so if you participate in a liquidity pool, you take two assets, you pair them together, you put them into the liquidity pool. If the ratio between those two assets fluctuates enough away from each other, okay, if they rise together or fall together, it's not a factor. But if they rise and fall apart from one another, that price ratio between the two might contribute to impermanent loss. Okay, they call it impermanent for a reason, because you only actually suffer from it when you remove yourself from the liquidity pool. If the price ratio between two assets fluctuates wildly away from each other and then they come back, well, guess what? The impermanent loss is truly impermanent. It's no longer a factor. So that's one variable that we have to consider. Number two is we're comparing it to the HODL value as if you had held those two assets unpaired. Here's what that means, and this is probably the most important consideration. When we talk about impermanent loss, it's a bit of a misnomer, right? It's not a great name for it, because if you buy two assets, let's say you buy Bitcoin and ETH, and they both rise in value, but one maybe rises a little bit more, then potentially there's an impermanent loss there. Because if you had held those two assets unpaired and just enjoyed the growth of both of those assets separately, maybe it would have been a little bit more than if you had participated in a liquidity pool and the value of that liquidity pair went up because both of those assets rose as well. So when we say impermanent loss, we're talking more about, oh, I could have maybe possibly potentially realized a slight extra gain if I had held these two assets unpaired. Now, we'll talk about the variable that actually offsets that potential loss, but we're not talking about loss per se. We're talking about, oh, I got an X gain. I could have had X plus 10%. That's actually what we're referring to here. Okay, so the type of impermanent loss where people say, well, what happens if one of the assets that you paired goes down? That's not impermanent loss. That's just your asset is losing value, okay? And that's the same thing as if you held them unpaired and the asset goes down as well, okay? So that's an important distinction to know, that we're talking about just the difference of what you could have maybe potentially gained compared to if you had held those two assets unpaired, okay? This is the variable that really matters. That potential impermanent loss is actually offset by trading fee income, potentially. Meaning, if you pair two assets together, let's say Bitcoin and ETH, that's an easy example, you're going to get a reward, an income from the trading fees by becoming a liquidity provider. And with Bitcoin and ETH, maybe that's 20 to 40% APR. Okay, so those rewards are expressed in terms of an APR. Now, if you ride the value of Bitcoin and ETH up, down, and sideways all over the place, and let's say you rode it for 6 months, and then you did all the math and you did all the impermanent loss calculators, and you go, oh no, my impermanent loss was 5%. I would have had an extra 5% gains if I had just held these two assets unpaired. Okay, but you held for 6 months on something that is 20 to 40% APR. Well, guess what? The trading fee income that you earned has now exceeded any impermanent loss that you might have incurred. Now, That's just one example. There's dozens of different variables that would come into play here. And yes, let's say your impermanent loss was a little bit higher and your APR was a little bit lower. Sure, you might come out behind at the end of the day. Okay. So that is a risk factor when considering impermanent loss. But when I say that some people think it's like the great big boogeyman in the background, they're thinking, oh no, if I participate in liquidity pools, I'm automatically at a disadvantage. No, you're not. You're just saying, I am confident enough in the APR that I'm going to earn from these pools that I'm okay with a small impermanent loss that, again, might occur depending on when I remove myself from the liquidity pool. So, in my opinion, the potential rewards of being a liquidity provider far outweigh any possible risk of slight impermanent loss. Okay. To me, the bigger risk would be the value of those base assets tank. Okay. Which is why which pairs you choose matters significantly, because what will cause impermanent loss, what will cause to your base assets to go down in value, volatility and discrepancy. So if you've got two assets that are just both wildly volatile, and the discrepancy between them of their price separates and stays separated, then yes, you will experience impermanent loss. So the big question is, you should be asking this now, how do I minimize the possibility of that occurring? And the two things I want to highlight today, obviously there's going to be a lot to this. It's more than just a little 2-minute video or whatever. But the two variables that I think play the biggest role, correlation and patience, meaning number one, correlation between two assets. If two assets, take Bitcoin and ETH, for example, they're highly correlated, meaning they don't rise and fall exactly together, but they kind of go up and down more or less together. The likelihood that Bitcoin will double in value and at the same time ETH will lose 50% of value, creating volatility and discrepancy, very, very low probability of that happening at this stage. More than likely, the stronger probability of what will happen with those assets is they more or less rise and fall kind of together because of their correlation factor, okay? And then patience is the other one. If Bitcoin goes up a little bit and ETH goes down a little bit, or ETH goes up a little bit and Bitcoin goes down a little bit, and there is this discrepancy between the price, my loss is still impermanent as long as I'm willing to be patient and continue to stay in that pool until the price of those two assets come back more in alignment with the ratio that they were at when I opened the position in that pool. Okay, I know that's kind of a long-winded explanation, but the point is, if you have a belief in two assets that you would hold long-term anyway, Bitcoin and ETH is a great example because I believe those are two great long-term plays anyway. You go, hey, I could hold these unpaired, but as long as I'm going to hold them unpaired and expose myself to the market upside, why not also pair them? I'm still exposed to the market upside, downside, sideways price action of the charts, but I'm also going to earn additional rewards on top of that. So if after 6 months, 12 months, however long I'm in this pool, even after that, if I still have a slight impermanent loss because there was a discrepancy between the price ratio of those two assets, that's okay because my rewards that I earned by being a liquidity provider are going to far outweigh any amount of impermanent loss. So all this, we come back to what are the main variables? It is asset selection, okay? That means simply, if you jump into being a liquidity provider, yeah, and you pair up Froggy coin, Froge, with a stable coin or something wacky, right? Like you're exposing yourself to a lot of risk and a high probability that not only impermanent loss, but like actual real loss occurs. But if you operate the way that we do in the mastermind, which is finding blue chip assets that have already proven themselves to be, by crypto standards, extremely reliable, right? By crypto standards. And you pair those together, you can still enjoy possible APRs in our target range of 50 to 100% per year on average. and you don't have to expose yourself to an additional unnecessary risk that you would if you select these extremely volatile assets, okay? If you want to talk more about that, I'm happy to chat with you. I don't want to make this video too long because we could educate on impermanent loss for like hours. There's already dozens, if not hundreds of videos on just like the mechanics of it online, which I invite you to go and check those out. You could probably search impermanent loss and find 20 videos in half a second. My point here was more to highlight when it doesn't matter and when it could be a factor. So if you want to talk more about specifically like your portfolio and how impermanent loss may or may not even be a factor for you if you choose to become a liquidity provider, go ahead and click the link below somewhere, wherever you're watching this. There's going to be a link that says like, hey, apply for the mastermind. Quick, short little application form, just some basic information so I can get a quick background on you. And then we'll just chat for 30 minutes and kind of work through like, hey, is this going to be a factor for me? What's a long-term strategy? How am I going to apply this premise so that I can enjoy not only the market upside of the impending bull run, but also an additional 50 to 100% APR on top of that? I can walk you through step by step exactly what that would look like specifically for your situation. That's all for today. Keep watching this space. I'm going to keep posting videos in our FAQ series, frequently asked questions, of which, hey, ROI is a big one. Impermanent loss is a big one. Got a lot of questions that people ask me on almost every call that I have with every applicant, and I'm going to be breaking those down and publishing the answers to those questions here. Catch you next time.